Inflation and deflation, two words that can strike fear into the hearts of economists and everyday citizens alike. These two economic phenomena represent opposite ends of the spectrum, and this is what I'm going to talk about for today's video. First off, let us define what inflation and deflation is. Inflation and deflation are both economic phenomena that refer to changes in the general level of prices for goods and services over time.
Have you ever talked to your parents or grandparents about what prices used to be when they were kids? If so, they probably told you about how milk and candy and hot dogs used to be much cheaper, and it's true. Over long periods of time, most things do tend to get more and more expensive. This is due to something called inflation.
Inflation is characterized by a sustained increase in the price level of goods and services, leading to a decrease in the purchasing power of money. Deflation, on the other hand, is the opposite. A sustained decrease in the price level of goods and services, leading to an increase in the purchasing power of money.
The opposite of inflation is deflation, which is a reduction of the overall level of prices in an economy. Economists generally view deflation as a negative thing, since producers respond to falling prices by slowing down their production, which leads to layoffs and salary reductions, ultimately causing the economy to stop growing. So that covers the concept of inflation and deflation.
Inflation is often caused by an increase in the supply of money in an economy that outpaces the growth in the supply of goods and services, leading to more money chasing fewer goods and services. This can result in higher prices as businesses and consumers compete for a limited supply of goods and services. Additionally, inflation can be caused by factors such as an increase in demand for goods and services, a decrease in the supply of goods and services, or changes in government policies such as taxes or subsidies. Deflation, on the other hand, can be caused by a decrease in the supply of money in an economy, leading to less money chasing the same or even an increasing supply of goods and services. This can result in lower prices as businesses and consumers have less money to spend, leading to a decrease in demand for goods and services. Deflation can also be caused by factors such as a decrease in demand for goods and services, an increase in the supply of goods and services, or changes in government policies. Both inflation and deflation can have significant impacts on individuals, businesses, and the economy as a whole. Inflation can erode the purchasing power of savings, decrease investment returns, and lead to higher interest rates, while deflation can lead to lower investment returns, increased debt burdens, and decreased economic growth. As such, central banks and governments often strive to maintain a stable level of inflation over time, typically targeting an inflation rate of around 2% per year. Now, with the question in the title of this video as to why inflation turns to deflation fast, James Rickards have something to say about this trend.
That is my view. I'm happy to explain it. And it catches a lot of people by surprise. They're like, wait a second, Jim, it's inflation. You just look at 2022, starting in January, it was kind of like 7%. Then it was, it's 8.1, it's 8.6, now it's 9.1, which is true. That is the series. It is going up. So people extrapolate that. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s.
Oh, and by the way, James Rickards is an American author, lawyer, and financial commentator who has written several books on finance, economics, and geopolitics. He is best known for his book, Currency Wars: The Making of the Next Global Crisis, which was published in 2011 and became a New York Times bestseller. According to him, while inflation is characterized by a sustained increase in the price level of goods and services, leading to a decrease in the purchasing power of money, deflation is the opposite. A sustained decrease in the price level of goods and services, leading to an increase in the purchasing power of money. One of the primary reasons why inflation can turn into deflation quickly is the impact of expectations. Inflation expectations can play a significant role in the behavior of consumers, businesses, and financial markets. When individuals and businesses expect inflation to continue to rise, they may adjust their behavior accordingly. For example, consumers may begin to stockpile goods and services, leading to increased demand and higher prices. Businesses may also raise prices in anticipation of continued inflation, leading to further price increases. However, if expectations shift suddenly, and individuals and businesses expect inflation to decrease or turn into deflation, their behavior may change in the opposite direction. Consumers may begin to delay purchases, expecting that prices will be lower in the future. Businesses may reduce prices to maintain demand, leading to a further decrease in the price level. Financial markets may also react to changes in inflation expectations, with investors moving funds from inflation-sensitive assets to deflation-sensitive assets. Another reason why inflation can turn into deflation quickly is the impact of supply shocks. Supply shocks are unexpected events that disrupt the production or distribution of goods and services, leading to changes in prices. For example, a sudden increase in the price of oil could lead to higher transportation costs, resulting in higher prices for goods and services. This type of supply shock can lead to inflation. With all that has been discussed, we can also infer that this trend brings its own ramifications. Number 1. One of the most significant consequences of deflation is a decrease in demand. When prices are falling, people tend to delay their purchases as they expect that prices will fall further in the future. This leads to a decrease in the demand for goods and services, which in turn causes a decrease in production and a rise in unemployment. This situation can lead to a vicious cycle where lower demand leads to lower production, which leads to even lower demand. Number 2. Deflation can have significant consequences for the economy, particularly in the area of debt. One of the main issues with deflation is that it can lead to an increase in the burden of debt. This is because when prices are falling, the nominal value of debt stays the same, but the real value of debt increases. As a result, borrowers who had taken out loans or issued bonds at a higher price level will find it more challenging to repay their debts in a deflationary environment. The increase in the real value of debt can have far-reaching implications for individuals, businesses, and governments. For individuals, deflation can make it more challenging to repay mortgages, car loans, or credit card debt. Even if the nominal value of their debt remains the same, the fall in prices means that their income and assets are worth less in real terms. This can lead to defaults, bankruptcies, and a rise in unemployment. Businesses also face a similar problem. Companies that had borrowed heavily to fund investments or expansion plans may find themselves in trouble if deflation sets in. They may find it difficult to generate enough cash flow to repay their debts, which can lead to a wave of defaults and bankruptcies. Moreover, falling prices can reduce demand for their products or services, leading to lower revenues and profits. Governments are not immune to the effects of deflation either. A deflationary environment can make it harder for governments to service their debts, particularly if they have borrowed heavily to finance infrastructure projects or social programs. Falling tax revenues and rising unemployment can further exacerbate the problem, leading to a vicious cycle of economic contraction. Number 3. Moreover, one of the ramifications of inflation turning into deflation fast is that it can also lead to a decrease in investment. When prices are falling, companies tend to delay their investments as they expect that the price of capital goods will also fall in the future. This situation leads to a decrease in capital formation, which in turn leads to a decrease in productivity and economic growth. Number 4. In addition to these economic consequences, deflation can also have social consequences. One of the most significant social consequences of deflation is a rise in inequality. Deflation tends to hurt the poor more than the rich. The poor have little savings and therefore little cushion against falling prices. On the other hand, the rich have more savings, which means that they are better able to weather the storm of deflation. What do you think of this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to our channel, and I'll see you in the next video.